Let's move on to our third category of asset classes, equities or stocks. And we'll talk about two main types. We'll talk about common stock and preferred stock. Remember, common stock is a share of ownership. It's a share of distributed profits or the profits that are reinvested for the owner's benefits. And we have earnings or earnings per share, net income. The difference is that when we're talking about an aggregate number, we talk about net income. When we're talking about a per share number, we talk about earnings. From this, dividends are paid and the rest is retained earnings. This is a residual claim, so you only get paid after the debt holders get paid. In addition, it's limited liability, and so the actions of the and liability of the corporation is separate from the liability of the owners of the corporation. In addition, a share entitles you to a vote for the board of directors. Yeah, maybe. Some corporations have more than one class of common stock with different voting rights, and so there's GOOG and GOOGL. GOOGL has voting rights. Common stock is often valued at a multiple of earnings. So this is be the price to earnings ratio. And this is a function of, well, let's see. We can look here and go through this sort of little derivation. We've done this before. Again, the price is going to be equal to the next dividend divided by R minus G, which is going to be the discount rate minus the growth rate. But I know that D1 is equal to the earnings per share times 1 minus the plowback ratio, B, meaning that if I plow back 100%, then there is no dividend. And if I plow back 0%, then all of the earnings are paid out. And so then I can now substitute in the numerator and then solve for the price earnings ratio. And so that I have the price divided by the earnings is equal to the amount that the company is reinvesting divided by R minus G. And so the point is that the PE ratio, this relative price measure, how much the stock is going to be worth, is a function of the discount rate, which is a function of risk. And we've talked a lot about what goes into R, the growth of the company, and the amount that the company is reinvesting. Next is preferred stock. And preferred stock pays a fixed dividend, and it's expressed as a percentage of the par value of the preferred stock on a quarterly basis. So for example, 4% preferred actually pays 1% every quarter, 8% preferred pays 2% every quarter, and that's always the rule. And that's exactly how they do it with, very similar to how they do it with bonds, where it's semi-annual APR. For preferred stock, it's quarterly APR. The preferred value is $25, usually is $25. The par value for preferred stock is usually $25, although a lot of textbooks will show this as 100. So 8% preferred pays 1/4 of 8% on $25 every quarter. You get a 50-cent per quarter dividend, regardless of the stock's price. And so the dividend yield, also expressed as APR quarterly, can change when the price changes. So if this $25 stock is priced at $26, the dividend yield goes down from 8 to 7.692. And if the price goes to 24, the dividend yield goes up. The same way that the yield to maturity changes when the coupon yield does not, the same thing is true for the dividend yield on preferred stock when the price changes. Preferred stock is usually cumulative, meaning that since the preferred dividend is paid before a common stock dividend, but after coupon interest payments, if you can't pay the coupon interest payments, you're bankrupt. But if there's not enough money to pay the preferred dividend, and therefore not enough money to pay the common dividend, then before common stock shareholders can be paid any dividends, it is usually the case that all of the past dividends for the preferred stock that were not paid must be paid. And so this is what's meant by cumulative preferred. Preferred stock is infinite maturity. So since the dividend payments are fixed and the preferred stock does not mature, it's kind of sort of like an infinite maturity bond. The difference, of course, between preferred stock and debt is that if a corporation misses a debt payment, it's bankrupt, and corporations can miss preferred payments without bankruptcy. Tax consequences. So for the corporation, preferred stock dividends are paid after tax. Remember that you remove interest expense before calculating taxable income and tax expense, but dividends are paid after tax. And so it costs the corporation more money to pay a preferred dividend than it does to pay a coupon payment But corporations that own other corporations' preferred stock are excluded from taxes on a portion of the preferred dividend. So there's the dividend received reduction. And so any corporation that owns any other corporation's preferred stock gets a 50% reduction. And if you own more than 20% of the company, it's a 65% reduction. And if you own 80% of the company, it's considered a subsidiary and you don't have to pay any taxes on the preferred stock dividends. In addition, the dividend tax rate for individuals is also lower than ordinary income. And remember, coupon interest is part of ordinary income, whereas dividend income is taxed at a lower rate. Preferred stock often has embedded options. And an embedded option is something that's written into the securities contract, which gives either the issuer of the preferred stock, the corporation, or the holder of the preferred stock, the investor, the ability to do something to sort of change the nature of the contract. So the first thing we'll talk about is a convertible option. And a convert option is granted to the preferred shareholder. And this means that the preferred shares may be exchanged for the common stock shares. And so the holder of the preferred stock gives up the preferred stock. The corporation issues new common shares, which are then granted to the preferred shareholder. And so the corporation no longer has to pay the preferred stock dividend, and they no longer have the obligation of the par value obligation. The preferred shares, again, can be exchanged for common shares at a predetermined number of shares. And this is what sets the convert price. So for example, if the preferred shares can be converted at a rate of 5 common for 1 preferred, if the par value of the preferred is $25, then the implied exercise price, the price you're effectively paying for the common stock, is where you're giving up something that's worth 25 to receive 5 of something that's worth, well, $5 a piece. So why would a preferred shareholder want to own common stock instead of the preferred stock? Well, they get to pay $5, but the market price could be significantly higher. And so this is often used in private or pre-public companies. Common stock gives control. Preferred stock is just an economic interest. But it might be the case that I have a small company. It's pre-public. It's a private company. I would really like your money. I don't really want you to have control. But if this thing hits huge, well, you just get a fixed payment. And so you're not interested in that. You really, really want a taste of the possible upside. And so the way to do that is I allow you to convert the stock to common stock at a relatively low price. And if we do go public and the price of the company explodes, then you can give up your preferred stock, which has your fixed dividend, to get common stock, which is now incredibly valuable, and you only have to pay effectively $5 per share. And so this is referred to as sort of an upside or equity kicker that can be added to this preferred stock. In addition to a convert option, which is often added as a sweetener for private pre-public companies to get people to invest in very risky businesses, you're going to get a fixed payment. And if the company explodes, you don't get an upside in sort of straight preferred, but if there's a convert preferred, then you can convert to common stock. The other type of option that's often used with preferred stock is a call option. And this is due to the other way preferred stock is used, and that's in white knight activities. So for example, if I've got an existing company, but I'm in a ton of trouble, and I can't borrow money from a bank, and I can't issue new stock because the value of my stock is so low, what I can do is I can issue preferred stock to a specific person, and Warren Buffett has done this numerous times. They act as what's known as a white knight. And so if I'm really, really distressed, what I do is effectively, I'm really borrowing money from Warren Buffett by issuing a whole bunch of preferred stock, and it's going to have a really high a really high dividend rate. And so I'm going to have to pay Warren Buffett a lot of money because it's a high risk thing. But as soon as I'm back on my feet, I want to stop paying Warren Buffett so that I can pay my regular shareholders a dividend. And so in this particular case, I might add a call option to the preferred stock. And a call option is granted to the corporation. The corporation can buy back the preferred stock from the preferred stock holder, usually at par, once the corporation has the money to do so. And they would do that. They would buy back or call the preferred stock so they no longer have to pay the preferred dividend, and they can now start paying profits to the shareholders. And they would do this when they had either access to new capital at a lower rate than is being paid on the preferred stock, or they just have accumulated the money through operations.